All right, we're starting our recording here. My name is Ray Arellano. I'm here with Alan Plyler, and we're just going to riff on a few things. This is our inaugural recording for Avoid Crisis, a new podcast titled Avoid Crisis. We're going to touch on a number of topics, primarily focused on finance and business finance. But it will drift into other areas as episodes go on. Alan, you want to have a word about what we're trying to do here and maybe introduce yourself and your background?
Oh, sure. Well, what we're trying to do is we're trying to help people understand situations that can, first of all, perhaps lead to a crisis, and how do you avoid that? And then we're also going to talk about where we've seen some evidences of crisis and try to make some observations with that. Maybe have some suggestions that might help some people that are currently facing this particular incident that we're talking about potentially today. And I'll let you introduce that topic later. As far as my background, I'm going to go all the way back to college, where I focused on business and also did a lot of work in accounting. But at the same time, was very interested in journalism. I became the editor of my college newspaper. So I've always had an interest in media. I wrote for the Chicago Sun-Times, as well as a number of other different periodicals and newspapers as a freelancer. And so I've always had an interest in journalism, and journalism in whatever form it takes, and that includes podcasts. So my work for a number of years has been with financial institutions. Worked with a number of those, both as a direct employee within the organization and also as a consultant to those entities. And I've been quite involved in capital markets for a number of years. So I've been involved in deals relating to SPACs and taking companies to the capital markets. Been involved in private companies going all the way to public. I've also been CFO of a computer consulting company that was a pioneer in the field and ultimately exited them through the capital markets through a sale to public companies. So have a lot of background and a lot of bank awareness, knowledge, institutional understandings. So way too much about me. I didn't hear as much about you. Why don't you tell everyone a little bit about yourself, right?
Sounds great, Alan. Yeah, I would tend to say you've been known in some of the situations you've dropped into as kind of the fixer, if you will. Situations that are kind of messy and need to get addressed at a very high level. And it usually does touch on regulatory things, SEC, risk management, designing products or structuring deals, all that kind of stuff. So it's going to be great as we go forward to hear some of this historical context, but then also to, as you said earlier, to put it in a position where people can use this today and in the future as they make business and professional decisions. My background, my dad was an entrepreneur, small business guy. He owned a barber shop in the 50s and 60s, and he owned a A&W restaurant in Sunnyvale before it was Silicon Valley. And I grew up in Silicon Valley before it was Silicon Valley. So tech is in my bones. Graduated from the University of Washington with a degree in accounting, started Big 8 CPA in San Francisco. Did about 4.5 years there, and then went out and was an accounting software VAR for several years when this new thing called Novell Networks was around. So we didn't have to walk a floppy disk down the hall to share a file. And that really revolutionized accounting in the small business sector. Obviously, all on premise. This is long before the internet and all that good stuff. After being an accounting software VAR, I had a client recruit me out to be a senior controller, worked my way up and was eventually a CFO, and the timing and geography was just right. It was the dot-com boom, and I was in San Francisco and CFO of or EVP, technically EVP finance of a software company that closed a Series B VC round. after the blow up of 9/11 and '01, jumped out into the not-for-profit sector. After that, just a CFO, and after that, started doing CFO consulting work, and that eventually I backed into having an accounting firm, so a CPA firm. I'm a CPA. I'm also PFS CGMA licensed, and what I found is that a lot of the issues that were coming up, either in, say, tax planning, deal structuring, debt structure, so on, operations, it all sourced from the accounting side. So I say people, process, tools. And so that's what our practice does today. And we'll talk more about that later. I want to keep going and get into some good meaty stuff. So the thing that prompted us, Alan, we've been talking for years about, we just have good riff sessions. Usually with alcohol involved. So this is, but we've had non-alcohol included discussions. And over the last 2 days, we've spent a fair amount of time talking. And just for context, today is Sunday, March the 12th. Friday, March 10th, was the day that Silicon Valley Bank basically went into receivership. And
yeah,
so,
can I interrupt you there for just a second?
Yeah.
Okay, I'm just going to make an observation here. Okay, I wanted to kind of know what was going on in the world, and so I did what I typically do. I go to the internet. I try to say, okay, what's trending now? Okay, and I looked for what was trending now, and as it turned out, the number one thing trending was daylight savings time. Okay. So here's what I was thinking, okay, so yeah, that's important, right? But what was the second one? It was about SVB. And then I thought, going back to what you're saying about March 10th, I mean, what a weekend to have the FDIC trying to figure out what to do by Monday, because they're losing an hour. They could use that hour, I mean, time is of the essence right now, right?
Yeah, absolutely. Absolutely. This is I feel this. I mean, I've been through the '06, the '08 meltdown, 2001, et cetera. And this one's different. Those who think it's geographically focused are going to have an awakening, I think, by the end of next week. Those who think that it's industry focused and that it's only going to affect tech and startup, this is going to have a larger ripple effect, I believe, when you look at investment portfolios. We've talked about the relation with crypto. It's a whole other episode, probably. But this SVB collapse there's a lot of buzz going on in the finance world, professional, accounting, tech, finance, startup world, and stuff like that. But this is the beginning, and it's going to be a big shift, and it's going to require some very deft management to come out of this thing okay. No doubt there's going to be winners and losers. There's going to be people who are going to make a lot of money off of this situation. And there's people who are going to lose a lot of money off of this situation. Right. And so that's the kind of stuff we want to talk about here to help get some insight and some ideas.
How about I just give you a little something that goes all the way back, because you mentioned the financial crisis. How about if I go back and just talk about something about what really got the financial crisis going?
Yeah, we can have an edited and unedited version if we want to jump to the stuff. So yeah, let's go there. That sounds great.
I'm just going to jump in, and we're just going to go back to say something here about, and this goes back to when I was working on providing education at Cal CPA Education Foundation, teaching CPAs continuing education. One of the things that I was working on was talking about convergence, because the FASB was coming up and saying, hey, we need to have standards that are really applicable across the world. And that seemed like a really good idea, something everyone can get behind. And they started to work towards that, and they made significant progress. So, I mean, a real testament to that is, first of all, AC 606, revenue from contracts with customers, and then IFRS 15 that aligns with that. I mean, they pretty much got IFRS and US GAAP pretty well aligned there. Another big change was ASC 842 on leases, and they brought that to the balance sheet. Okay, but prior to the actual financial crisis, which we started to see in 2008, there was another indicator of an issue that the SEC was dealing with, and that was really related to loans related to subpar credit lending, effectively a lot of auto loans. There was a lot of focus then at that time, and so it was autos. But what was brewing at the same time was a situation with banks overall. So if we go back to 2007 and we go back to Metropolitan Savings Bank out of Pittsburgh, Pennsylvania, their deposits and everything were taken over by Allegheny Valley Bank in Pittsburgh. Following that, and that was in February, following that in September, NetBank out of Alpharetta, Georgia, had all their deposits bought out by NG Direct, which was out of Wilmington, Delaware. And then in October, you had Miami Valley Bank from Lakeview, Ohio, that was taken over by Citizens Banking Corp. The whole point was there was a set of three. And I'm talking about this all happened in 2007. And then in 2008, we started to see even more banks starting to fail and get taken over. So there were banks that were failing way ahead, three in 2007. And then you had, let's just say, maybe 9 other banks that failed before you get to Lehman Brothers, which everybody knows. And people think, oh, it started at Lehman Brothers. It didn't start at Lehman Brothers. It started way earlier than that. And it had to do with subpar lending. Think about lending, and subpar lending is lending of risk, right? It started with people who got money who didn't pay it back. Okay. And then it also had a lot to do with what these financial institutions were investing in. If you buy an asset and that asset value drops, well, your balance sheet just got corroded and eroded, right? So what do? You have to make it up somewhere. Now, you can make it up with making more money. That's going to help, right? But to make more money, maybe you have to take on more risk. So there's this really clear association about how much risk there is in the system. And you're also having to look back at when you see something fail, to your point, it may not be the last thing to fail. What starts out as something that seems relatively containable can get to the point where it's not containable. SVB is the second largest collapse in the U.S. ever, Washington Mutual being first. But think about this idea of the threes. What are the threes that we've seen? FTX, and I'm not going to say that's just the U.S., but obviously there are a lot of people in the U.S. that lost money in FTX. We just had Silvergate right before SVB, and now we have SVB. Okay, and that's either the beginning of something or it's the opportunity, right? It's the opportunity for change. It's the opportunity for correction. It's the opportunity to not necessarily just assess blame, because it's really easy to come up and say, okay, we can assess blame. But we also have to look at what really led to this. Why did this crisis, because this is a crisis right now, to your point, this impacts California. It can impact a lot further than California, because SVB was a institution that had a global footprint in many places. So you think about Canada, you think about Germany, you think about China. I mean, they have involvements in Europe. I mean, there are other impacts because, again, who is going to pay the balance sheet receivable? Because what is a loan on the bank's balance sheet? It's a receivable. How are they going to get that paid? And they have the liability to the customer, right? And that's the deposit side. But there's a lot of different sides of it. One part helps the other. And this can be a very large issue that can just have a lot of tentacles.
Right. The Silicon Valley Bank has a UK entity, and that has been shut down. So, Monday morning, London, they're going to be unraveling this thing and over there. So, yeah, this is going to be quickly turn worldwide, and it is going to expand beyond the tech industry. a lot of portfolios have got exposure here, etc.
Shanghai Pudong Development Bank, a 50-50 joint venture between basically a U.S. entity with SVB and a Chinese entity. Okay, what happens whenever you have a 50-50 joint venture where one partner all of a sudden has a change in their liquidity position?
Yeah.
I mean, so it does have global impact.
Yep. I do want to say, because of the timing here and the urgency, I want to save some of the history and the lead up and the alignment that got us here. That's going to be a lot of material on that, particularly as the FDIC and the regulators kind of unravel this thing. They're essentially going to be taking SVB's assets and selling them, on the market, and theoretically getting some pennies on the dollar, right? I mean, it's not going to be 100% of what it's on their balance sheet for. Who would do that? And so,
yeah, that's one possible thing, right? I mean, all
Okay.
within what is the normal construct, and that's maybe part of the question. Maybe you're going that direction, like what should happen here? Because there's what you are allowed to happen, what is totally to the law says you should do this. We have certain amounts that are insured. We have certain amounts that are insured. How do we proceed? Well, we have the laws, okay? But what really should happen here?
right. So, well, let's talk about that a little bit, because what we were saying in our conversation yesterday was that everybody under 250K is going to get paid off out of current liquidity and reserves, and if the FDIC needs to step in under the FDIC insurance, great. But everybody with account balances under 250K, well, insured account balances, right? If it's in a checking, savings, that kind of thing. If it's in a brokerage type account, that's a whole different discussion. But
okay, let's start right with that. With just you put a ring fence around if your deposits at SVB Bank are under 250,000. Should you withdraw them immediately?
Well, okay, great question. If I were the CFO of a company right now that had over that amount, absolutely, I'd take it out in a heartbeat.
No, I'm just saying if it was 250,000 less, do you take it out?
Yes, that's my answer.
Okay.
What's your opinion?
Well, I mean, you look at that and say, okay, why would you, right? I mean, like what risk are you taking by leaving the money in? I mean, the FDIC says, hey, here you have this. Do you know what's going to happen tomorrow? Do you know what's going to happen Monday? Do you know what's going to happen Tuesday? What you do know is the FDIC is saying, hey, if you want to take this money out of the bank, we'll help you. Here you go. So, yeah, I mean, as what do you do now? If you have less than 250,000 in that bank, you can decide that you want to leave it there, but it may be more prudent to say, well, maybe it's time to just find another account in another bank. And this goes back to the winners losers that you were talking about, right? So that is maybe the obvious for if it's under 250,000. Let's go to the next part about you got deposits that might have been in the millions there because that's your bank of choice.
Right. So I believe the next step is that FDIC basically issues paper, says, okay, let's say you had $2 million. So you get FDIC paper, and then as they unwind that basically liquidate the balance sheet, they can start redeeming that paper for cash to these account holders.
Yeah. Okay. So let's just go back into your experience. You have a round B, you raise that money, you got that money. Now you have a responsibility to take care of the people that are investors there. And so what you did is you put the funds into SVB. You're the CFO, right? Now all of a sudden this happens. Okay. And the balances in this scenario here, it's a hypothetical because we're not going back in time, but let's just say today you were the CFO, and I'm just going to throw a number out there. You had 10 million in the bank. You're saying, hey, I can get 250. So now, right? Okay. So what are you going to do as the CFO? I mean, what are you going to be thinking about? What are the options that come to mind? What would you do potentially? You got paper, right?
Okay. Well, yeah, right. I mean, there's two sides to look at this, and that one is what's my liquidity and access to cash, and then the other side is what's my demand and my need for cash, and timing of it. Because it's all about, at this point, it's all about timing, which ironically is what got SVB's, butt in the vice, is that they actually have a pretty good balance sheet, and from an investment perspective, it's just not liquid, and it needs time. It needs time to come to fruition, and they had a run on the bank, and it just all the alignment was just right, and it imploded. But from a managing a company's cash flow at this point, you got to line those two things up. And I'll tell you, the big one you keep hearing about is payroll. And as it sits now, in fact, I just this morning had a discussion on this topic with the esteemed Claudia Castillo from Resolve Employment Law. And she confirmed that, hey, look, there's nothing out there yet about any kind of relief on the laws, very stringent laws, of paying payroll timely.
Oh, wow,
The government does not like it if you don't pay payroll within certain periods of time. And you have to specify this. The longest you can go is 30 days, right? So if some companies do have monthly payroll, particularly if everybody's on salary and it's just a set thing and whatever, or say if they're on a commission. So let's say, okay, payroll's once a month. Pretty rare. What's most common is semi-monthly, 15th and end of month. You can get bi-weekly, every 2 weeks. In construction trades, you usually have weekly payroll, but that's the cycle.
There's going to be certain entities, startups, call them VC back, whatever, who are going to say, you know what, for my immediate cash needs, maybe the VC's got funds that they can help out on. Maybe I have investor calls that I can make and get some additional investors that can get me through the short term.
Right.
Maybe that helps. Like that is really like, what do I do for any kind of liquidity crunch? And hopefully they've had some sort of reserves just in case, just for normal cash flow. But again, some of these things are a level of sophistication. Remember, startups go through an evolution of, we don't know anything. We do know our product. We don't know anything about accounting. I mean, I've seen that happen a few times, right? But eventually they're like, we don't know about treasury management. And maybe they're not prepared. And who's the backstop here? And what ends up happening? Now, you talked about if it's over 250,000, the FDIC is going to give you paper, certificate, whatever it is, and theoretically that has a value because it's a potential receivable. You're going to get dividend, et cetera. So can you do that as a company? Can you say, hey, employees, what we're going to give you is we're going to give you a fractional interest in this piece of paper we got from the FDIC. As soon as that comes in, we're going to go ahead and clean up your payroll. It doesn't pay your mortgage, does it?
No, it doesn't. I don't. Yeah. I think giving IOUs for payroll is not does not comply with the law.
Okay.
So that's not going to work. So what's going to be, and to your point, you mentioned in there about in VCs or quite frankly other investors having to fork over some cash in the short term to bridge companies through this crisis. That's what has to happen. You got to get your hands on cash. You got to pay certain things on time. And that's going to be starting with payroll. And then, the way that money's going to come from is you either had a good treasury management where you were diversified across at least more than one bank, or if you're truly stuck and you were all in at SVB and you're truly stuck, it's now time for your shareholders to step up. And if it's VCs or if it's founders or whoever that is, and where you're going to have to get some cash together to get through this over the next couple of weeks. That's it. Those are the only choices.
Jumping back into this thing about saying before how it started and going back to the history, I know you don't want to repeat a lot of this, but the whole point is once you start to have the cracks in the windshield, what happens is that crack gets bigger and bigger until finally the whole windshield collapses.
Right.
And this is a pretty big crack in the windshield.
Yep. And so next week's obviously going to be very intense, and a lot of stuff's going to happen. It's going to be a whole nother world a week, Friday afternoon, because we'll know a lot more of how this is going to play out. But meanwhile, I always said that in the CFO seat, you don't get to sit and wait. You don't get to punt. You don't get to say, "Oh, I'm not going to," not my job. You got to handle whatever comes across your desk. And this is it. This is the hand you've been dealt. You got to deal with it. And there's no doubt there's going to be other vendors. I saw that Brex has been stepping up with a lot of capital. I read a post from Ramp. Ramp is a really the cool fintech spend card. Ramp has announced that anybody who has an SVB problem, you got to substantiate it, right? And then, but they're going to be better terms, more lenient on some of the cash flow issues to help people through this, allow them to continue to spend and so on to get through this. So Brex and Ramp have already stepped up. We're going to see other places stepping up. That there's a marketing opportunity. Say, hey, come on over here, open an account with us, or we can make you a bridge loan for 30 days or something to get you through this. Yeah. There's going to be a lot of that going on. And footnote, mark my words, there's also going to be a hell of a lot of fraud. people ginning up and cooking up fraudulent SVB bank statements and then floating those around and saying, hey, I have, $10 million at SVB, please give me a loan. And they're going to take that money and run. So there's going to be a fraud angle to this when this is all said and done, and we're counting the dead bodies. That's going to be one of the fatal, the collateral damage of this situation. But that's a different podcast.
Well, yeah, and the thing is that SVB itself, in its prior disclosures, has talked about the issues about fraud that has occurred with them. So, and there's been warnings too, saying, okay, when all of a sudden you take away the employees and the whole operations of the bank in many ways, are they doing their job? Does this open up an opportunity from hackers? Because banks, who wouldn't love to just go ahead and help to issue out the deposits, right? Whatever. So right, there's other risks that could be happening that we don't even see.
Well, yeah, there no doubt that basically FDIC is running the place over there. Come Monday morning, well, probably as of now anyway, already, right? So there's no doubt that they're going to be making some sort of offer to the existing workforce at Silicon Valley Bank. It's got to be a multiple, right? 1.2, 1.4, 1.5 salary to hang around.
Okay, so let's talk about that, because we talked about depositors have things that they need to do right away, which is you got to find a liquid source, a cash source, something to take care of the operational business issues. And if you can't, you're in serious trouble. If no one's going to step up for you, you need to be making some calls to some other places, right?
Right.
You've got a very big problem on your hands, and that ripples through the California economy, that ripples through the U.S. economy, that ripples through the global economy. So this is a serious problem that needs to be solved. And it's got the attention of Gavin Newsom, it's got the attention of Joe Biden, it's got the attention of Janet Yellen. I mean, those are important decision makers in this situation. And they need to understand just how bad the reaction can be from the U.S. public, who is disseminating information now through social media faster than ever. And the biggest risk overall is yielding to fear, right? The entire bank system. If you begin to really fear that it isn't really something we can rely on, like I've said, I think if you spend all your money you don't have to worry about losing money because of the bank, right? I mean, it makes it simple. But that's not possible for most people. They really rely on, okay, I need the bank because I have to process payments to these people, that people, whatever. All of a sudden, what's happening with wire transfers? There's a lot of loan receivable. There's people that are supposed to be paying their loans, and they're supposed to be paying those back. I mean, what if they just say, hey, I'm just going to wait a little bit to pay that back? And why would they wait? Maybe they don't have the cash to pay that back. Because think about how they needed cash coming from different places. I mean, the amount of how it interfaces, it just is, it's amazing. I start thinking about this, for example. You think about how many employees SVB has, and then you think about how many connections there are in Silicon Valley. You hear about this 7 degrees of separation. How many degrees of separation in California is there from SVB? I think it might be 2, maybe max 3 for almost everybody in California.
Yeah.
Probably within just 2 to 3 of your connections, you're going to hit someone who has an involvement with SVB.
Yeah. Yep. Mm-hmm. Interestingly, as a footnote, Friday we're cloud. My firm, we're cloud based and paperless. We do all of our payments electronically. I pretty much demand that my clients pay by ACH, etc. I am the treasurer of a small not-for-profit that I'm a member of, just to help them out. And yesterday, in the mail, I got from one of our members renewing their dues a paper check, which already drives me up the wall, but from First Republic Bank. It's obviously from the company's the client, but the bank is First Republic Bank. So I got a check on Friday written against FRB. I'm like, what the hell do I do with this? I'm going to deposit it through the phone app and just hope it goes through, but you'd expect it would, right? But it cracks me up in that, to your point, how many degrees of separation in the Bay Area? It is probably 2. In California, you're right, the most 3. In the U.S., can't be more than 4. Anyway, so yeah, the regulators are going to have to come in a very strong way, and reassure the market. The concept of contagion was been talked about a lot on Friday afternoon, evening, and Saturday on, like, CNBC had a lot of information about that. And there's already been lists of, 10 other banks with similar profiles of, everybody's talking about the investments and the liquidity issues. And they're also talking about the percentage of demand deposits above 250,000, et cetera. And how SVB is kind of an outlier in a lot of these statistics. But you take that stat, that metric, and you go, okay, now let's go rank all the other banks. And anybody who has a profile that even leans in that direction, all of a sudden they're getting looked at. People are getting worried. Should I pull my money out? And these runs, like it spreads like the virus. Like, we just dealt with the virus. It spreads like a virus pretty damn quick. So they got to tamp this down quickly. Assure the market.
Yeah, and there were people lined up in front of banks in California. And I don't want to name names, but definitely in California, there were people lined up on Saturday morning, and they were pulling money out, and they may have not been anywhere near 250. Doesn't matter. The fact that these, the law of small numbers applies here as well. I mean, we're talking about the big depositors, but if you added up all these small numbers and what ends up happening with banks across the country, if people say, you know what, putting money under the mattress isn't such a bad idea, and I better go grab what I have in the bank right now out, because I just don't know what's going to happen to the entire banking system. Again, this is fear. Right?
That's a whole nother thing, right? Now we got a high inflation environment. You got cash. You got Benjamin sitting in your dresser drawer. It's like, come on, that's not a good move. But I hear what you're saying. It doesn't need to be rational, right? There's so much of the market movement and stuff that happens in economics is psychological, not technical, right? So, to that regard, a high interest rate environment, and then where does that cash going to go if you're going to take the money out of the bank? I mean, could this give the bump back to crypto because it's been suffering coming into this, or does the crypto side take more of a hit because of how much SVB was involved with directly and indirectly in the crypto market? Right. And that's a whole nother episode in depth, but
right. Yeah. I mean, good questions, but let's go back. I mean, crypto gets into a lot of complexities and it's not easy to understand, and neither is banking. But one thing about banking to understand is that the reason why a bank run is a risk is because the bank can't just sit on the deposit. Right. That doesn't do any good at all. They have to use it and they have to earn money from it. And so that's why the net interest margin is, widely looked at, factor that is analyzed all the time. Now, thinking about interest rates overall, you go back 200 years, what was the average interest rate? It's going to be closer to like 6%. But in the U.S., we've had times whenever the interest rates have been a lot higher than that, 15%, 16% in the past, right? Now we're just inching back towards the 5-6 area overall. We're not going to count credit cards. That's a whole other, topic. But you think about that and you think about what's going on with the Fed moving in that direction. It's not really extremely out of the ordinary for them to be moving in that direction on the basis of looking at what's happened over the last 200 years. But whenever you put it into the context of we've just come out of a period where there's incredible stimulation to the economy through the COVID programs and the response by the government, you have to factor that into then why did we see all these other economic events occur? And, what do you do with all that stimulus? And what do you do as far as using interest rates? If the interest rates continue to move up, part of this has been, a question of what does the impact of interest rates have on the economy? What is the impact of interest rates on banks? And there's a lot of correlation between those two. And so the banks have to really have an understanding of where interest rates are going to go in order for them to properly invest in the environment. The more confusion there is and the more uncertainty there is, the harder their job becomes to manage their money properly and wisely and prudently. So the whole thing is that when we talk about contagion and we talk about the masses, we were at risk in the 2008 financial crisis. And, it took very, very large amounts of money to stabilize the system. This is not quite the situation as far as we see it right now, but it is not really contained. And talking about how it's isolated and they are just a small part of the overall money system, now that may be true from a number standpoint. But again, if you go back to what I'm talking about as far as separation, you talk about impacts. I mean, think about how much California produces in the GP of the U.S. But think about how much the U.S. supports economies of the entire world. I mean, this is a crack in the windshield, but what is the windshield we're talking about? It's one that we don't want to see that crack end up destroying the windshield.
Yeah, ultimately it's the global economy, and everything's been setting up for people have been talking about recession for a while now. A couple of years since, the pandemic was a different time. It stoked a bunch of monetary policy and fiscal policy that put money out in the system that was artificially cheap, essentially, right? Didn't cost you anything to have cash, and that cash needed to find a home. And then because of the shutdown supply chain issues, we know this story, right? And then you end up with too much demand for too few goods, and you end up with inflation. And here we are. So going forward, the impact of this is on the liquidity of the market. That this cash has to go somewhere now, right? It's tied up with SVB. Again, we talked earlier about it's just a timing issue, but it has to go somewhere. And I personally would be long on, I would look down the list of banks that are going to position themselves well in this crisis, both from a technical perspective, but also from a PR perspective, and also from a marketing perspective. Are they going to offer special products? So are they going to come out and say, hey, you somehow substantiate that you have these accounts, and we will immediately, within 48 hours, get you a line of credit so that you can pay your payroll, so that you can pay, whatever other urgent bills that you have, and get you through that. And we're going to fast track you through an onboarding process, AML, KYC, other vetting, and just within a limited scope. And maybe we're going to have to get your attorneys and your CPAs involved to help substantiate who you are. Oh yeah, they've been my client for, 10 years. I know they're good. And you start having these personal relationships with bankers, they're going to push this stuff through. But it's going to have to, you get a bank that comes up with a process like that and offers products like this to those affected. And that's going to reassure the market. It's going to provide the needed liquidity. It's going to get them through that. And those banks are going to gain very loyal customers. And that could be a big win. You're going to see some banks pop, I think, on an upside because of this, if they handle it correctly.
So winners and losers, going back to what you mentioned before. Yeah. Okay. So take a potential winner or loser, call a regional bank who says, you know what, we'd love to have some of the clients that SVB had. And we'd love to take over 100% of whatever their contractual relationships were with SVB. Does the FDIC actually allow that? Okay, because here's where right. I'm going with this, right? I mean, SVB prided itself with being a lender to the innovation economy. Okay, and then what was the way that they actually ended up showing, nice pops in their revenue, nice pops in their bottom line? A lot of it had to do with exits of those companies that they had loaned to in the public right. markets. Okay, right. So we go back here and we look back over the last, call it 12 to 16 months. What's happened with the SPAC market? I mean, how many of these blank check companies out there have been holding on to cash right. and don't have anywhere to go with it, right? So would they be able to find a way to be involved, as an example? And I'm not providing any solutions here. I'm just saying that just think about, we're looking at a big liquidity thing. And so then think about the hedge funds that are out there. Would they like to be involved and trying to get involved with this? Because here's what's, we talked about the balance sheet of SVB. Here's what's not on the balance sheet of SVB. And this is actually something that should be looked at as having value that needs to be understood. SVB has awareness and has details on intellectual property. If they are lending to these innovative companies, they have a pretty good understanding of where they're going. They could go over this list and go, okay, I'm going to tell a hedge fund which ones you really want out of these innovation companies, right? I'm going to tell you, okay, this one, they're working on this, but you don't want them. I mean, right. I had them over on a series, D or whatever, I know who they are, but this one over here, they've got this whiz kid from, wherever, and they're doing this, and we don't even know what this is, right? I mean, think about how much of the U.S. technology footprint that exists in the U.S. and think about how many employees are out there that have been touched over the last 39 years from their involvements with SVB. Just think about it. So think about how much intellectual property is resident within the minds and within the documents and understandings of SVB. And it's not on the balance sheet. It's not on the balance sheet at all because of the accounting rules, right? This raises up the whole question about how do we value intellectual property? Well, now we're going to get a chance to possibly see what that value is, except we're not if it's not understood, and if it's not sold, and if it's not borrowed against. I mean, if that entire package of value was somehow assimilated and properly valued, what would it be worth? If you could bring an intellectual property value to the balance sheet of SVB, what would it be worth?
Well, we're gonna find out, but with the caveat of a fire sale, right? so let's, to your point, that part of the deal structure that SVB did, and I've not only seen it, but I've been involved firsthand, is that, they'll often take warrants. And I mean, this, you've helped on the other side structure some of these kinds of deals. So, they've got skin in the game in multiple directions. And that was part of the problem there, is that it was the risk, the concentration of risk. It was that triangle between the VCs, Silicon Valley Bank, and the company, the tech startup company.
Mm-hmm.
And so the VCs were parking cash at Silicon Valley Bank, but they were also borrowing money from Silicon Valley Bank. The tech companies were out raising money, and the VCs were being equity investors in the tech company. So they'd give them 10, 20 million bucks. And then they'd say, okay, but go put that money at SVB. It was kind of part of the deal. It was, everybody knew, everybody understood. Whether, I don't know if it was written in or not written in, but either way, everybody knew what you're supposed to do and what you're not supposed to do, right? The auditors would get away with it, and they'd just say, "Oh yeah, we put a footnote in the cash paragraph. They have a money in excess of FDIC insurance and blah blah blah." They'd go get one of those paragraphs and cut and paste it in that audit report, right? And everybody just skipped along all fine, and it worked great for 30 some odd years, right? To your point, 35 plus years. Well, it works until it doesn't, and and then the bank has a total conflict of interest, because now they're lending money to the VCs, they're getting money from the VCs, they're getting referred the portfolio client from the VCs. The VC, the client, the company tech startup is banking at Silicon Valley Bank, and then they're going through the IPO and doing stuff, and Silicon Valley Bank is jumping on the ride and getting warrants on the back end. So now they got an equity holder. This triangle is a closed loop. But what you end up with is a complete concentration of risk. And nobody saw it that way because they saw these different separations. They go, well, so what if one of these companies goes bankrupt, which happens a lot of times with startups, right? They don't make it to IPO. The next best thing is if they make it to an acquisition. Okay, great. But a lot of them either die on the vine, or maybe they do get acquired, but they get acquired for, 10 cents on the dollar because it just didn't work, right? So some of these things don't pay off. They felt the diversification of that risk is, yeah, but I got 100 or 1,000 or 5,000 of these. 1 or 2 or 5 or 10 go bad. Who cares? All I need is that 1 or 2 to pop, and we'll make up the difference plus more. And that worked great for a long time, until it didn't, until you had this run.
Yeah, when you talk about the triangle, I think that you are 100% identifying some of the connections, the sin that goes between these different operations and how they all kind of tie together. One of the things that I express it as is like the 360 view. If you can take the 360 view and say, how does all this come around in the circle and how does it all tie together? Then you can get an understanding a little bit about why it's so critical that the right actions take place right now. It's really, really important, because if you just think about, if you were to do like Google Maps 30 years ago of Silicon Valley, and you look at that and you jump to now and you look at that, what you see is a development that is something America should be proud of. Something that is just incredible about how tech and innovation has changed the economy of the U.S. Okay. And what's at risk here is not saying that can't continue, but if it's going to continue in a different form, now this 360 relationship that you're talking about, how, as long as everyone's winning, right? Everyone's winning with their piece. If you think about it, it's one really big arrangement. It's a big deal, and everybody's making their piece of it, and they're also contributing their part of it. Now, whenever you start to split this off into banks that never were able to compete in this area before, couldn't, they walked away from it. They said, we can't compete with SVB. And they were right. A number of companies looked at SVB's financials and were like, oh my gosh, these guys are making money. We need to do what they're doing. But they couldn't. You know why they couldn't? Because they couldn't build that 360 circle of friends and family and relationships that it took to allow the innovation to occur. So, you know, when you hear people like, for instance, from Y Combinator coming out saying, hey, this is a risk to the innovation economy, you're right. When you hear somebody like Sam Altman coming along saying, hey, something needs to be done here, you're right. Because these people know how SVB has helped them. And these people are aware of what the real impact's going to be. I mean, you know, what do you do when your rich uncle dies? You know, you can't ask for an ice cream cone anymore, you know?
Right. Yep. Yeah. It's interesting as the story goes, that SVB was ideated. It was conceptually conceived, right, in Silicon Valley, by Bill Biggerstaff and Robert Medeiros, who came up with the idea over a game of poker, right, in the early 80s. Kind of ironic, kind of interesting, right, that it was a poker game, how this thing started. But as the concept and the timing was perfect as technology in Silicon Valley was growing up, that this was the bank that could grow with it, because traditional banks didn't understand tech, they would look at a conventional set of financials. And you hit on this concept earlier, Alan. I'm going to poke into this a little bit about how US GAAP does not properly value intellectual property. But the VCs knew early on, and I'll give you a couple of really great examples. Amazon lost money for years and decades, and they got hammered by Wall Street. Nobody understood. What they were building was infrastructure. They were building customer base. They were improving processes. They were investing in technology to be incredibly efficient for people to buy anything and get it quickly and get a great price. And when they finally kind of had that done, and they would stop investing into customer acquisition, and they could now just run the machine, boy, you saw some real profit drop to the bottom line. You saw some real cash flow being generated. And all of a sudden, everybody goes, oh my God, Amazon's this and that, and it went through the roof. But if you look at the first, 10 years or so of Amazon, it wasn't that way. And it wasn't perceived that way in the market, right? And so the VCs understood this, but the traditional banks didn't. So they just made their own bank.
So I'm going to go ahead and just parlay into what you just said about Amazon. I'll give you some other thoughts that go into Amazon. Okay, everyone knows the story about how there was this relocation of Jeff Bezos coming out to Washington, right? I mean, you head west, young man, right? I mean, because same thing. Mark Zuckerberg comes out to Silicon Valley. Jeff Bezos goes to Washington, and Elon Musk is somebody who came out of California as well. So, as far as the money with PayPal, et cetera, and, Peter Thiel, same thing. I mean, you trace all these people, but let's go back to Amazon's a bookseller, right? And they have to figure out a good way to do the sales of books. And so what do they need? They need a really good e-commerce platform. What does that require? It requires engineers that know software. Okay. Now, as that is getting built out, there could have been an innovation company that was focusing on how do I build the best e-commerce platform. Now, that company might not have been public, but Amazon may have known about that company, may have brought them into the fold, and may have been relying on them. Okay, now just take that as an example. Amazon now, you can buy practically anything on Amazon. And if you don't believe that, take the Amazon challenge. I have something you can't find on Amazon. And then let's see, it'll probably show up 30 days later because you tried to find it. Point being here that there's a lot of other companies that are public, that are right now using on a test basis, potentially even more integrated than that, companies that have not come public that have been financed by SVB or the VC community. Those companies that are providing those services, if they go under, what ends up happening to the company that's been trying to incorporate this with the idea that they're going to be around for a long time, and we can go ahead and bring this into how we do our entire build of what we're doing for serving customers. So think about fintech companies, right? A lot of fintech companies out there trying to get a different piece of the market, and they're relying on software that's being developed by innovation companies that are funded and supported by VC communities that are tied to the SVB. There's a lot more going on in this whole intellectual property space of developed and undeveloped and yet to be developed software that is critical to deployment. So it's really a question of how do you preserve that, because think about the contributions that California has made to the GDP. Again, Silicon Valley has made to California. Think about the tax base. Think about the payroll taxes that get paid. Think about the real estate taxes that are getting generated from municipalities. I mean, if you're not worried about the fallout here, you should be.
Absolutely. Absolutely. So coming back in, let's bring this back round. And then I think we're probably bumping up close to an hour here. Yeah, we are. Look at that. Look how that happened.
I don't know.
Flies.
I don't know. We're going to have another podcast soon.
Yeah, right.
It feels like we're just scratching the surface here.
We are. And I think what we're doing, and we've talked about this before, is to take any one of these topics and to drill in deeper on it in particular. But I think to wrap up, give the overarching what we've talked about is this has happened before. You went back to a previous crisis and how a couple of years before it was leading up to it. And that's pretty true. It's interesting with a lot of black swan events. People go, oh God, I never saw that coming. And then all of a sudden they start digging through and looking through the data, and it was there. The signs were there. We just didn't recognize them. And so, and there's stuff that's going to happen tomorrow that's going to be the same way. So as a professional, as a business owner and an entrepreneur and advisor to businesses, that's part of what we need to do, is we need to think about what are some of these risk vectors? How do we diversify against it? And what does it take? And you know what? Oftentimes, diversification is going to make it look like you're leaving money on the table. You're not maximizing profit. And you know what? You're absolutely right. Because risk has a cost, particularly when it goes against you. So that sword cuts both ways. And, that's the big lesson, is to remember that and then to implement that. So what that means all of a sudden, and I've been involved in those companies where we had huge concentrations of cash at a particular bank, you're not going to see that anymore. You're going to start to see people with 20, 30, 40 banks. And now that we have the internet and online banking, it's a lot easier to do that, right? So that's going to be a big change that we're going to see. Treasury management.
Sounds like a startup idea to me. Well,
there's plenty of banks in the U.S. Just
think about it. You line up 40 of them and say, give me your 10 million deposit, and I'm going to load it off onto these 40 right here. Yeah. And I'll give you a certificate of insurance for the remainder that's not covered by FDIC.
Above the limit, right. And then your risk is pretty low, because by the time they burn through 40 times 250, you're in a pretty good spot. That's one.
Okay, the other one, 60. All right.
There you go. The other one is I was researching out, because I'm obviously right in the middle of this. I was researching out, and I'm not going to say the bank yet, but maybe tomorrow. is that there's a product that does an overnight sweep up to $1.25 million that's FDIC insured up to 1.25 million because they're sweeping out into other accounts every night. So your money might be back at the bank for the day, but it sweeps out at night, and that kind of refreshes it and cleans it. So it keeps the risk away, right? So you're going to be above the 250. You can keep at that particular bank, but mitigate that risk because of how their sweep product works, and that they're using basically co-insurance through other banks in a sweep account. And you're getting, I think today it was yesterday it was like 3.25% interest. Not bad. But you're going to see CFOs and treasurers becoming more valuable in this area. And all of a sudden, all right, let's get back into the discipline of laddered treasuries. Every 90 days, you're going to have a chunk of cash that's going to be linked to treasuries, and they're going to come due, and that's going to be your base of operation that you can count on. You're just going to go back to basics.
Yeah, and there's risk to the innovation economy that happens with that too, right? Because all of a sudden, instead of investing in the future, you're investing in the short-term return. And so that's what I'm saying is there's a lot of impacts that just have to be thought through on this. I know that we're coming up to the time. Sounds like that entity you're talking about has a really great solution. I'm sure they'd be happy to be a sponsor of this podcast. I'll let you work on that.
I'll be working on that. That sounds great. So, Alan, any other closing comments of people? Like, what should people do? This probably isn't even going to post until mid next week, but by the time this gets out into the public as a podcast, any other final closing thoughts? It's going to be a few days out next week. So let's just say mid-March through the end of March. What should people be thinking about and doing?
Well, I think that they need to take stock of their personal situation, number one. I mean, if you are an employee of SVB, you need to have a resume that's up to date. You need to be firing that all over the place. And there will be places that will be willing to hire you. There are a lot of great employees that are at SVB, and, they are well worth giving consideration. The crazy thing about this is a run on the bank could happen to any particular financial institution just by the very structure of banks. So think about your risk with the bank overall. Think about that relationship. And is it working for you today? Will it be working for you tomorrow? Think about that a lot. And then, look, interest rates are going up. So get in front of your debt. Cut back on other areas and start cutting down your debt, because it's going to cost you a lot to keep that debt.
Yep. Yeah, I think that's some good points. Your first one is, as an employee, as a worker, how does this affect you in your career and your income stream? The second point, I think, is as an investor. If you own SVB stock, or if you own any single bank stock, be careful. Diversify it around, right? Or any company. Forget about just the banking industry. You can't have over concentrations of risk. We've learned time and again, diversification in the long run is a great thing, right? And then, if you're neither an employee in that industry, if you're not an investor in that segment, you can learn from that and at least have that one step removed, and that it's not going to radically affect your life, but it should be a good lesson for reflection to go, it's time to take stock again and to make the necessary moves to diversify and to be aware of concentration risks and things like that. So, and then the final piece, I think, on my side would be CFOs, financial professionals, accountants, and other advisors. They really need to be in touch with their clients, with their companies, to identify these same issues. But the immediate need is cash flow. And if you got it elsewhere on your balance sheet, great. You can meet your obligations. If you don't, you need to go find it. The fastest way might be to talk. You should be doing a parallel tracks, talking to existing investors, but then also go out and talk to other banks and lenders and financial institutions that might be able to help you through this, whether it's like a Brex or a ramp on a spend side, or whether it's an actual bank that may have some sort of bridge product that they're going to be spinning up over this weekend and launching early next week to get bridge cash flow in to get through this crisis. But this is going to be a cash flow crisis for a few people, and you just got to deal. And at the end of the day, do not blow out all your cash on anything. In my opinion, just, whatever. If it were me, if I were making this decision, I were in that position, and it was all the cash I had to make payroll. Personally, I would not make that payroll. I would live with that penalty later, because you got to keep some powder dry as things go along. So those would be my closing comments as we wrap up here.
All right. Well, it's, as always, Ray, a lot of fun to get into these topics, and hopefully it's helpful for our listeners as well.
Sounds great. And I guess we should announce the name. We came up with a name, and we've actually got the URL. We don't have the site up yet, but by the time this all gets produced, hopefully we can have the site up. You want to unveil that?
No,
and how I'll tell you, I'll unveil it, and then I'll let you do a quick bit on the concept behind it.
Okay.
Right. So, we came up with avoid crisis. I think we might have mentioned this at the beginning.
Yeah.
So avoidcrisis.com, and it obviously relates to business, it relates to finance, but it relates to a lot of other areas in life as well. So Alan, we riffed on that pretty good yesterday. I'll let you give you some hear your thoughts on that.
Well, if you want to avoid crisis in life, one of the things you have to do is you have to think a lot about the what ifs. What if this happened? What if that happened? What are the risks? And to avoid crisis, I mean, certain things are unavoidable, but when you talk about avoid crisis, a lot of it comes down to the decisions that you're making every day. You make decisions that are good decisions, and you continue to get the benefits of those good decisions. If you make a bad decision, it may take a number of good decisions to unwind that, right? So there's a lot of different issues that we have that we can talk about, and we will talk about, which are really about, we see this potential crisis coming. How do you work on avoiding it now? And then obviously, what steps do you need to take? This is a good example. Right now, it's a financial one is what it appears, but it goes well beyond financial, because there's going to be a lot of impacts to people's lives. It's going to require change. What existed a week ago doesn't exist anymore in the same form. And it's going to morph into a lot of other things, and we're just going to have to adapt as we go forward. But that's the goal of the podcast, is to talk about topics that are relevant to the listeners, and to be able to, provide our thoughts of just how we're thinking about it and thinking about possibilities. And so hopefully it's interesting content for everyone, and they're going to continue to listen in.
Sounds great. Wonderful. Nothing more to add to that. That was great. I love it. And I'm really looking forward, Alan, to producing more shows, more content, coming up with ideas. And of course, listeners, you're welcome to send in your ideas. We're happy to do some research. Who knows? I'm sure in the future we may have guests come on and stuff like that as the topics evolve. But avoid crisis. All right. Thanks, Alan. Take care.
Take care.
All right. Bye-bye.